Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. Welcome to Stocktake, the podcast from Intelligent Investor. For a free trial, visit intelligentinvestor.com.au. I have here with me this morning Graham and Nick. We're going to talk about three things. Firstly, the declining state of listed companies. Secondly, we're going to cover two of the biggest stocks in the Australian-based tech boom. Let's kick off with the ASX. A quick guess. How many listed companies do you think were on the ASX in, I don't know, let's pick a year, let's say 2000?
I always have 2,000 in my mind as being the current amount, but I feel like that could be out of date.
Have a guess. 2,000?
I'll say 2,500.
Okay.
Yeah.
Nick?
I'll go 1,500.
Okay, not far off. 1,381 in 2000. The figure now, I think, is about 1,960. So the ASX has actually bucked the trend. When you look at the other major markets around the world, there's a definite trend towards fewer listed stocks. So if you combine the New York Stock Exchange, the NASDAQ and the Amex, in 1996, there were 8,000 listed companies. Have a guess as to how many there were in 2023.
5,000.
Not bad, 4,300. Similar thing on the LSE as well, less than halved. More than halved since 1996. So let's get into this, because for investors, it's a bit of a problem if there are fewer listed companies available to invest in. Let's start by having a guess as to why this has happened. Who wants to take a stab at that?
Well, I'm curious now why Australia has bucked the trend.
Shitty mining companies, I'd say.
Yeah, it's an interesting statistic about the Australian market, and I think the Canadian market is we have the highest percentage, which is about 75% of all companies here are unprofitable. So that this shows you how many mining explorers we have. Yeah.
Yeah. Okay. So what about the two major markets? Because I think if you took out say stocks under $200 million market cap, and then adjusted that for, say, 20 years ago, you would see the same effect. There will be fewer listed companies that weren't mining stocks, small cap mining stocks. That's what I would guess.
Yeah, I would too. I think one of the big reasons this is happening is consolidation, right? So there was this. You mentioned the numbers in the US, John, where the companies have fallen from 8,000 to 4,000. Dartmouth did a study, and if you adjust for public-to-public mergers and acquisitions, where essentially two public companies becomes one, the numbers really haven't changed actually that much. So there hasn't been as much shrinkage. So this shows you how much consolidation there has been over the last 2 decades, and I think that's occurring because we've had really low interest rates. We've had deregulation. There's been, antitrust regulators don't have as much teeth as they perhaps did in previous decades.
Or the will to do anything when they have.
Exactly. And so a lot of these industries are becoming oligopolies and duopolies and even monopolies. And the conglomerates are just getting, far larger than I think compared to any other time in history. So I think consolidation explains a lot of it. And then on the other end, I guess we don't have as many IPOs as we did before. Part of that is actually the conglomerates as well. Like if you look at a company like YouTube or Instagram, they were bought very early on by Google and Facebook, but they would be two new businesses at some stage that would have listed and would be probably multi-$100 billion market caps, but they never got the chance to. So there's been a dearth of new listings as well. So it's a bit of a
Well, Graham, what about the rise of private capital? Because it does seem that private equity, for example, is taking more companies private. And there's also the fact that there's just a lot of money around. And if you are, say, like for the past 10 days, I've been reading about SpaceX and Starlink, just researching that for a story on Friday. And, that company has done astonishing things with huge amounts of capital, and all of that capital has been raised privately.
Yeah, that's where my mind first went when you were saying that the number of them had declined, is that you've seen at the same time this big rise in the private capital markets over the last kind of 15 years or so. And I think more of the deals before companies list are going to those. And you're also seeing them take over the nice companies that are already listed. So I can think of at least half a dozen big stocks that I've covered over the years that have been taken over by private equity. So I think as more capital has flowed into those markets, it's just kind of absorbing all of the public ones. And you can see why companies would prefer to give to sell themselves to a private market is it's just less regulated. They don't have all the issues with dealing with shareholders, with all of the different presentations that they have to release and the rest of it. So particularly when they're wanting to move quickly, they're wanting to raise capital without all the fuss of public offering, then the private markets are a pretty good way to do that. So
yeah, that's right. I mean, the regulatory burden, I think, has probably increased, but the amount of private capital that's available has also increased.
Yeah.
And if you're running a business where you can say we need to raise $100 million and we don't have to announce to all of our competitors that we're doing it and this is what we're going to spend it on, then you would choose a private option as a business owner or a founder, wouldn't you?
Yeah, absolutely.
And I think that's like the rise of that sort of patient capital from super funds and private equity and venture capital mobs. It's taken away one of the real benefits of actually going public, which used to be that I could tap out, shareholders at any point, say emergency like COVID or when I want to make an acquisition, and get money coming in. Whereas now you just call up KKR or Australian Super and they've got just endless amounts of money. So you don't need to rely on public markets to provide that liquidity. It's available privately. And I guess these large, endowment funds and super funds, they don't mind keeping companies private for far longer or taking them off the market like they did with Sydney Airport, because they don't have to market those assets as often as they do publicly. So there's less volatility in those portfolios as well, in theory, than they would be if they were publicly listed.
Yeah.
And I think the added competition within private equity, as more private equity funds have popped up and there's just more capital sloshing about, they're paying much better prices than you might be able to get from the public. So some of these takeovers, if they're all being done at 30% above what the public markets are valuing the company at, you can see why the private companies that are considering whether to list or not might think they're getting a better deal by selling to private equity up front.
Right.
Yeah.
So is this a problem for investors, the fact that you've got less choice?
I think it must be on some level. There's got to be a benefit to having more options available. But I don't know whether most investors would know it at the moment, because the top stocks generally account for such a large portion of their portfolios or the index anyway. So if 20% of your index is in just 4 banks, then what does it really matter if the 100 tiny miners didn't list with you or whatever? It may not have a big impact, but I think over time it must.
Yeah. Nick, what about you? Do you think it increases the argument for focusing even more on monopoly-style businesses?
Yeah, and it does, and I think whether you like it or not, a lot more of the public companies today than in the past are going towards being monopolies. So, and this is why it might not be as much of a problem for investors as they think. Is the largest companies, if you look at our the large tech companies in the US or other companies that have rolled up complete industries, they are the main beneficiaries from that consolidation trend, and they tend to still be public. So investors have really benefited over the last, couple of decades, and the returns on public equity markets have been just as good as any private numbers I've seen from private equity funds or even endowment funds. So I don't think investors are losing out, but it is a risk if those next companies aren't coming through to replace those previous market cap leaders.
Yeah. Okay, we're going to take a quick break and we'll be back with a discussion on two of Australia's leading tech stocks.
Want to give your kids or grandkids a solid financial head start? Just $50 a week could grow into an $84,000 nest egg by the time they turn 18. Sounds good, right? But it does mean looking beyond traditional savings accounts, especially with rates falling. If you're ready to explore smarter, long-term investing strategies, InvestSmart has a free ebook that shows you how. It covers investment options, tax traps to avoid, choosing the right account structure, and even ways to get the kids involved. Ready to move beyond the piggy bank? Download your free copy today at investsmart.com.au/guides.
And we're back. We're going to kick things off with a discussion of WiseTech and what is the biggest deal it's done yet, which is saying something because this is a company that has had a long history of growth through acquisitions. It has just, I think what's the size of this deal, Nick? 1.2 billion?
2.1 billion. 2.1 billion.
Wow.
US dollars.
Okay, so why is WiseTech spending so much money on a US company called E2Open?
Well, it's the reason they're doing it. It's all about trying to fulfill their vision of becoming the Microsoft Office of logistics. And so far, WiseTech.
Is that your phrase or is that Richard White's?
No,
just want to clarify that.
That's Richard White's phrase. If they do get there, the stock's a buy today. But there's risks to it as well. But what E2Open provides WiseTech is 5,600 customers and a few really good supply chain modules that they pretty much didn't have. So there's not much overlap between the products that WiseTech has today and E2Open has, and the customer overlap isn't a great deal either. And the reason why is E2Open focuses on beneficial cargo owners, which it's a fancy way of saying the big importers. So think like retailers and manufacturers, the Nikes of the world. Whereas WiseTech's focus has been the freight forwarders, the people that actually are organising and moving the goods. And so their vision here is if we can get more sides of the entire supply chain onto our platform, then we can create a really multi-sided marketplace where everyone's connected, shipping can become faster, and goods can become potentially cheaper as well.
So this is like the Microsoft Teams with Excel and Word built in then?
Sort of, yeah. And the supply chains, like we think they're, pretty. You would think they're pretty like tech savvy and all the rest of it because you've got to, when you order something on Amazon, it rocks up to your door pretty quickly. But it's actually a pretty archaic process, like getting it from a factory in China to a store in Australia or the US. There's a lot of manual data entry. There's a lot of problems. Each port has different rules. Each country has different customs compliance. So it's a real headache. And a lot of these companies have been using either in-house software or software modules that aren't specifically designed for logistics, whereas WiseTech really offers a logistics-specific software module. So it is that's the grand vision and why they're paying so much for E2Open. But there are a lot of risks.
It's a big but, right? It's a big but. So let's just clarify this, right? Because over the past decade, WiseTech has taken over 55 companies and rolled them up. E2Open is also a roll-up, and it's acquired a dozen supply chain software businesses in the last, 4 or 5 years. But it is a basket case. The share price is down 75%. So it seems to me as though WiseTech might be taking on a whole host of hidden problems here. And it's only been a month that they've been looking at it by the sound of it. So is that the big risk here, that they're buying a sack of potatoes?
Yeah, absolutely. Integration risks and that they don't know what they're buying are the two massive risks here. And the other one is the funding, which I'll touch on in a second. But if you look at the integration, the CEO said on the call yesterday, the WiseTech CEO. It's the WiseTech founder, Richard White. He used to be CEO, but he's not CEO at the moment.
For reasons we won't go into. We don't want any more Ritz.
Yeah, exactly right. He said that essentially...
I'll just say that if he makes a friend request on LinkedIn, just reject it.
Anyway, he said that you just can only do minimal due diligence when you're buying a US listed public company, and made this point that you can't even talk to the product managers or the developers. So they are sort of going in a bit blind, and they've also said that because E2 Open, it's not very clear that they've actually bedded down what they've bought. WiseTech are going to use external advisors to accelerate the integration of the of E2 Open, and I'm just wary whenever I hear external. Yeah.
They haven't done that before, have they?
Oh, not that I know of, but using external advisors to integrate your largest acquisition to date suggests a bit of a rush to me. And I guess the other big risk here is the funding. For the first time that I can remember, WiseTech isn't raising equity alongside debt to buy the business. It is completely debt funded, and it's their largest acquisition to date. So debt's going to go. So the balance sheet's going to change from a net cash balance sheet and a very conservative balance sheet to one that's actually levered 3.5 times to EBITDA. So that's a fair bit of debt to take on, and other companies that are levered over 3 times are typically packaged goods companies, very stable businesses, and you could argue WiseTech is as well with recurring revenue and the rest of it. But so that funding of the deal makes it really messy and really amplifies the risks. If something does go wrong, they're going to be left with all this debt, and of course there's the classic risks of taking your eyes off the ball of the existing business, and a large overseas acquisition. This is a NASDAQ listed company. Australian companies don't typically buy overseas companies that well, or historically they haven't, at least. So there's a lot of risk.
What do you think of this, Graham?
I think you've got to give management a little bit of credit for picking up a company that has been performing poorly and its stock is down so much. Because usually you find acquisitions that they always are buying at the latest high. The stock has been rising consistently for ages, and then they're the last ones to jump on the bandwagon and end up overpaying. So as much as it sounds kind of scary, and I don't like the idea of a roll-up buying a roll-up, I think that, I don't know, it sounds a little opportunistic that they would do it at this moment.
It's almost value investing you're suggesting, Graham, eh?
Well, it just does kind of hint that way, but I definitely don't like all of the points that Nick just raised, and outsourcing your integration seems like they're just going to kind of see how it goes and hope for the best. But I think they're at least being bold and maybe not overpaying if it's already a very depressed like if investors just have very low expectations for this business.
I don't know. Like you two know this company far better than I do, especially you, Nick. But to me, I mean, I get Graham's argument there about this being a value-based acquisition, and I'm kind of fine with that. What worries me is not just the debt, it's also the fact that they have outsourced the integration. You've made 55 acquisitions in the past. You must be good at integrating new businesses. Why you would outsource it, possibly to developers who don't even know the tech stack at WiseTech? I find that baffling. I don't know why a company would do that.
I probably should clarify. They said they're going to use external advisors. I assume that means alongside the internal resources as well. Okay. So I don't think this is completely, will be completely reliant on external advisors. But still, it was a point that sort of worried me, particularly alongside the comments from the CEO that we can only do so much due diligence, and the fact that
you do your due diligence after you've paid the money.
Yeah.
It's a lucky dip.
it's a bit of a worry. But look, the rationale here and the opportunity is, it's pretty clear. Like, this is an $11 trillion industry, logistics, and they, at the moment, WiseTech estimates they spend less than 1% of that on software, and WiseTech is only a small, percentage of that 1%. So it's a huge opportunity if they get it right. And if they can connect all these players, essentially anyone not on WiseTech will have to come onto WiseTech, and it will create a real network effect, and they'll be the incumbent and potentially fulfill that vision of becoming, the Microsoft Office of Logistics. But huge risks as well. So it's a bit in the too hard basket. I mean, we've kept our recommendation the same and sort of waiting to hear more from the company, which they said they'll disclose more at the end of year result.
We've got the share price down.
Do you think they might have been doing it just to prevent a competitor buying it? And they don't really care about it?
Potentially, though, I guess the other argument... so E2 Open were going through a strategic review. So that, that thought probably makes some sense, that maybe they just wanted to keep some of these software modules out of the hands of others. And I've seen a few other investors note that they might actually spin off parts of E2, that they don't want to own all of it, that they just wanted to keep some of it, and that could definitely be the case.
Okay. All right. Well, we've got the share price risk as high. We've got the business risk as high. And we'd be looking at buying probably, if the share price fell, another 35% or something. But you'll be paying close attention to when they report in the AGM in August, where you'll be looking at this detail in more detail. Okay. Yeah. Let's now move on to a company which I would argue is probably less risky in a business sense. Maybe more risky in a share price sense. Graham, tell us about Pro Medicus and your $1,000 fantasy. When he says $1,000 fantasy,
my $1,000 fantasy.
He's not thinking about leather boots. He's thinking about Pro Medicus being, 4 times the price it is now.
It's fun to dream. Pro Medicus has to be one of the best investments that has happened in the last 15 years in the ASX. Yeah. From a company standpoint, that in 2009, this little kind of imaging archivist bought for $5 million the Visage system that it's now the whole company essentially, and it turned that $5 million into a $30 billion company, which is just crazy in the space of 16 years.
I was researching this. I mean, well, not researching it. I was reading about it earlier in the week for my pecuniary interest email. So the company listed in October 2000 at $1.25. And it did nothing really. I mean, it went up, it doubled sort of by 2012, but even by 2000, like 10 years ago, the price was sort of just a bit over double what it was it listed 15 years beforehand. All of the share action has really just occurred in the last 10 years. It's been an absolutely incredible surge.
Yeah. I think part of that is due to the underlying company growing and taking its market share in radiology, but that's been a fairly slow grind, though it's picking up pace. But a lot of the share price rise has been just people realizing that and suddenly revaluing the current earnings, because it's suddenly based on these dreams about future earnings. The company at the moment earns $100 million or so a year, but it isn't, as we explained in the review, it isn't hard to get to multi-billion-dollar net profit a decade from now.
So let's just go through that then, Graham, because you said that the bull case is so exciting, you were kind of scared to even write about it.
Well, yeah. I've been kind of avoiding the stock because it's one of those companies where if you're looking at it based on where it is now and its past, this share price doesn't make sense at all. It's just completely lunacy. It's trading at like 200 times what it's ever earned cumulatively or something along those lines. And no value investor is going to look twice at this thing. But if you start thinking about where the momentum could take the underlying business 5 years from now or 10 years from now, the current market cap actually doesn't seem as crazy, but it's a lot harder to justify if you're trying to prove future earnings and a journey that it hasn't actually kind of traveled yet.
Right. So you say that there's kind of four pedals that are driving potential growth, future growth. That's market share growth, pricing power, product innovation, and competitive dynamics. Can we go through each one of those and just give your view on each one, starting with market share?
Let's actually start from the end one with the competitive dynamics.
Okay.
This is where the company's opportunity has really kind of originated from, is that there was the previous way of radiologists viewing their scans was through kind of on-premises hardware. It was very slow, clunky, it took forever, and that just slows them down. It was basically that. I think I can't remember who said it, but there's a good quote around what Pro Medicus is selling, and it's selling a preventative for radiologist burnout that it just stops them kind of having to deal with so much stress in their day by making them much more efficient. And so the company kind of has the cloud space to itself. It's competing against other much larger providers in Siemens and Philips and some others. But in terms of who's doing it well in the cloud, then Pro Medicus is definitely the front runner. I even saw a survey recently that said half the hospitals are considering switching to Pro Medicus' software, which is where the opportunity is, because Pro Medicus only has a 9% share or so at the moment. And so if you have this situation where half are trying to switch and you've got this tiny market share currently, then you could imagine it increasing its current revenue by at least fivefold based on that statistic alone. But on top of that, the company's doing very good contracts with these hospitals and providers where they're usually 5 to 10 years. There's typically price escalations after that. And so you can pretty quickly imagine today's revenue compounding at a very quick rate. It could easily double, triple, quadruple over the next 5 years. And beyond that, this is just talking about the American market. So once the company really takes off overseas, assuming it can replicate its success in America, then you're getting into many billions of dollars worth of revenue.
Yeah. And what about product innovation? Because it's recently moved into cardiology, and there's artificial intelligence as well.
Yeah, I think the AI...
It's got all the things, Graham. All the buzzy things.
It's got every buzzword in there. But it's one of the companies that I don't think it is just about a buzzword. There's hardly a stock on the ASX that I think could do better than Pro Medicus in terms of its ability to utilize AI, because you've got the whole radiology industry is essentially based around identifying anomalies in images. And at the moment, the doctors, radiologists can do a better job of that. But there are cases where AI is able to spot these anomalies more effectively, or at least help the radiologists in interpreting results or the scans more efficiently. And so, yeah, the AI picture over the next 10 years could mean that the radiology profession swings very heavily towards kind of a computation or a computer-based analysis. And Pro Medicus is basically the best case out there to be at the front of that wave, where it's offering the interface with the radiologists and the scans.
I thought it was really interesting how this company is approaching it, because the temptation would be to, well, we've got all the data, we can build the models, we're going to do this ourselves and we'll charge people for it. Pro Medicus is taking a different approach, right?
Yeah, I think it's taken a very sensible approach, which is it's essentially wanting to position itself as more of an app store. It has taken the view that it's not going to be the best model developer, and I think that's fair given there's hundreds of them out there competing with it. And instead of trying to develop the fanciest model, it's going to offer the platform for all of those different models to compete on and to be able to get distributed to the different... to the radiologists. So it's essentially made itself into the iPhone and is letting others take care of the apps. And that seems like a pretty, I mean, we've seen it with Apple that strategy can work. And it seems to me that would be probably a less risky approach to dealing with this AI tailwind than trying to come up with their own models.
And I think there is an Apple lesson in there for Apple. Apple should be doing that in AI rather than doing AI itself. You do an app store for AI apps rather than do Image Playground in iOS, which has just been a disaster. I think it's a good illustration of how when you're not sort of working in your core area, horrible things can happen. I think this is a really smart approach, Graham.
Yeah, I do too. I've learnt from Siri being unable to turn on my lights half the time that they should stick to being a platform.
Never has a phrase "first world problem" been more relevant.
Sometimes I have to use my hands. Can you believe this?
Okay, so let's talk about valuation, because honestly, this company is incredible. The growth story is fantastic, but man, is it really hyped up?
Yeah, but over 10 years, it may not be that hyped. I can definitely make the argument that it's undervalued today, which seems so ridiculous to say out loud. But if you do look 10 years out, it looks a lot different to where it's standing now. And I think it's got the momentum to actually get there. It's not just $1,000 dream. I think there's a decent chance it does reach that.
Yeah.
In the long run.
We've never managed to get this company on the buy list, and I think that's because we probably have approached it with that conventional value investing lens and underestimated the quality of the growth that is in this business. There was a chance there. We got very close where we had a buy price below 150, and during the Trump tariff thing, it got down to about 175 or something like that, Graham. You must have been close to pulling the trigger there.
It's definitely grazed the point where you have to consider an upgrade, but it has been really, I would even say 2 years ago, a lot has changed, where the momentum has just kept building, and it's taken on some of its largest contracts to date just in the last couple of years that are multiples of the size of previous contracts. And yeah, I think our hesitancy, I mean, it looks ridiculous in hindsight that we missed a stock that has gone up so much, but I think that hesitancy was justified up until now, where when it had a 3% market share and it was competing against companies that were 100 times bigger and had all of the budgets in the world to outcompete it, it wasn't a sure bet. But the people who did bet on it obviously have done very well, and they were correct. And our hesitancy meant we left some money on the table. But from today, we'll see if we make that same mistake again.
I'll tell you a little story from way back where when I worked in advertising, we got offered a potential contract, I think, doing the marketing for this small company called Pro Medicus, which I think we had a meeting in Rose Bay, and this isn't going to go anywhere. Just another little software company trying to sell to radiographers. There's another one.
Even
for volume
the name
2 of
sounds a bit scary.
Yeah, that's right. Anyway, okay, thanks for that, Graham. Fascinating company. What we need is another market panic, and hopefully we'll get the opportunity to buy it. That's it for this week. Thank you, Graham, and thank you, Nick. It's been a very interesting episode, and we'll speak again in 2 weeks' time. Thanks for listening.